Can you please remind me the finishing point of the last lecture? Did you discuss anything about,
আমরা স্যার we discussed three things, sir. So one is like আমাদের যে input, processing, and output, sir. Since that was the beginning class, sir, we ended there, sir.
So did you discuss the definition? What is, say for example, planning, coordinating, controlling, etc.?
Yes, sir,
Yes,
we discussed, sir. We discussed.
Give an example of
Yes, sir.
applying functions
You
of
gave us an
management
example, sir.
by a production officer. Is it?
Yes, sir, you did it.
So operations management, it is one of the part of the total management of an organization. We are still defining what operations management is, and we have said that the operation management ultimately converting inputs into outputs. While they are converting inputs into outputs, they are carrying out the functions of management, of planning, coordinating, and controlling. And we said that planning, coordinating, and controlling are ultimately the functions of management. Management 212, that was our prerequisite for this course. And planning, in your management principles of management course, you know the function as planning, organizing, staffing, leading, and controlling. Planning means deciding in advance, and coordinating means organizing, staffing, leading, communicating, motivating the employees, and finally controlling. Controlling and planning is related. Did you discuss these issues?
yes, sir.
Yes, sir. So while the operations manager are concerned for the product, process, and supply chain, they takes care of time, cost, quality, and flexibility. That means operations manager deals with the product output. That means input, processing, and output. They discuss about the processing, and the operations manager discuss about the supply chains. And supply chains means that, say for an example, when you are producing any product, say for an example, garments. When you are producing garments, you are purchasing raw materials for garments. Say for an example, fabric. Fabric is also supplied by another supplier, yarn supplier. So there are a lot of chains in the production network that is known as the supply chain. Supply chain and processing, we will discuss more details about processing, the way we are converting the inputs into outputs, and the way we are using for converting the inputs and outputs is known as processing. In operations management, we will discuss in details about processing, say for example, capacity planning, process requirements, statistical analysis of the process quality control, statistical process quality control. We discuss more details about it. And while we are converting inputs into outputs, operations manager or operations management transform inputs into outputs. While they are transforming the inputs into outputs, the operation manager plays the role of value adding. Value adding means that increase product value at each stage. Value adding, what is value adding?
Sir, sales minus outside raw materials.
So maybe did you discuss how to add value?
Yes, sir.
Okay, there are 4 factors, isn't it?
Yes.
There are 4 factors of production, and every factor is contributing to the value added. And say for an example, if we buy raw materials from outside, and if we use labor cost is increasing the value, product value. When we are paying rental for the room, land, the product price is increasing or we are increasing the product value. When we are paying wages for the people who are working there in the company, that means there are four factors of production. We are paying the prices for the four factors of production. The price of entrepreneur is what? What is the price of the entrepreneur?
Profit.
Profit. Good. Profit. So we have discussed about the value added, is it?
Yes, sir.
So then operations manager improve productivity, and while they are improving productivity, they are bringing efficiency in operations. Did you discuss these issues, how to bring efficiency in operations?
Yes, sir.
So what is productivity and efficiency?
So productivity is just the ratio of output divided
And
by
input.
input.
And efficiency?
It's just improving the productivity year by year basis.
Year by year, or when you are comparing with the other competitors. You are comparing in the same year with your competitors. For your output divided by input and your competitors' output and input. If your productivity is better than the competitor, your operation is efficient. And if your productivity is worse, your productivity is inefficient. All right?
Yes, sir.
Getting the point?
Yes, sir.
Okay, that means we have discussed about this issue. The operations manager deal with product, process, and supply chain. Product means anything offered to the market, or usually it is known as market offering, maybe tangible or intangible. Service is known as the intangible product, and goods are known as the tangible product. Product may be, say for an example, computer is a product, and the product is addressed as the market, computer market. Market means the buyers who buy the product, isn't it? Then conversion means converting inputs into outputs, and inputs may be land, labor, capital, and entrepreneur. And supply chain means the interconnected networks of production process. You know that while we are producing garments, we are taking raw materials from fabric companies. Fabric companies are taking raw materials from yarn companies. Yarn companies are taking raw materials from the fiber companies. Fiber companies are taking raw materials from the petrochemicals, especially synthetic fiber manufacturing companies are taking raw materials from the petrochemicals. So there is a linkage of the production. This is known as the supply chain. We will discuss the supply chain as a separate chapter. All right. While the operations manager is converting inputs into outputs, the operations manager takes care of time. Time is very important issue, because if you can reduce the time, what will happen? The impact will be reduction of expenses. Say for an example, the lead time. Here the lead time means the time in between receiving an order and delivering the product. The delivering the product will be here. Delivering the product, the time in between receiving an order and delivering the order. It is known as the lead time. Garments industry in Bangladesh is receiving order from the customers and deliver the product to the customers, and the time is known as the lead time. The average lead time to produce a garments means an order. The average time to complete order in Bangladesh is around 90 days. And the same order can be completed by Chinese manufacturer in just 30 days. What is the impact? Impact is on expenses. There are three, expenses: manufacturing cost, one is raw materials cost. There will be no changes in raw materials cost. However, there are some indirect effect, but we are not talking about the indirect effect for the moment. That means to finish our order, the raw materials cost will be same. The second one is labor cost, wages. When you can finish in just 30 days, you have to pay 30 days wages. But when you are finishing the same order in 90 days, you have to pay 90 days wages and salaries of to the workers, laborers. So if you can, as an operations manager, reduce the lead time, this will ultimately reduce your labor charge. If you can reduce the lead time, what will happen? The factory's overhead, manufacturing overhead will decline because you can produce the product in just 30 days. You do not need to use the factory for 90 days. So 2 months salary, wages, manufacturing overhead, you can save by reducing the lead time. So operations manager must be responsible to reduce the lead time. Time is one of the important factor the operations manager takes care. And then cycle time, the manufacturing time, from manufacturing start time to manufacturing end time. This is known as the cycle time. Cycle time and throughput time is same. The time takes to convert the inputs into outputs or manufacturing started and manufacturing ends is known as the cycle time. If the cycle time the operations manager can reduce, this also ultimately will lead to reduce the cost of manufacturing. And value added time, another time concept that we'll use in calculating production efficiency. We will also discuss these issues in a separate chapter. Production capacity planning. Here the throughput time and manufacture cycle time is same. But when you are converting inputs into outputs, that means you are starting manufacturing and ending manufacturing. There may have some interruptions. Non-value added time. There may have some interruptions. Say for an example, the workers are going to the wash. The raw material supply is not supplied on time. The machine may break down. There are some interruptions. When you are deducting interruptions from the throughput time, you will get the value added time. So value added time must be less than the throughput time because you are deducting the interruptions for workers, interruptions for machines, interruptions for raw materials. You are deducting, and then you will get the value added time. And the operations manager will try to equalize value added time and throughput time. That means there will be no interruption, there will be no supply chain raw material supply problem, there will be no worker related problem. Then if there is no interruptions, what will happen? Your throughput time and value added time will be equal. Are you getting the point? Time issue. Operations manager is a manager who is ultimately responsible to convert inputs into outputs. While they are converting inputs into outputs, they will try to minimize the time of conversion. Minimize the time of conversion, and the minimization will lead to cost reduction, and cost reduction will lead to generate more revenue for the company. So operations manager is responsible for increasing revenue for the business by reducing time. It is the most important job of the operations manager. Operations manager is also concerned for the cost. Lead time and cost is related, isn't it? If you can reduce the time, what will happen? Manufacturing cost will decline. The operations manager deals with this cost or the manufacturing cost. As operations manager is working in the manufacturing field, operations manager deal with the manufacturing cost. And what are the manufacturing costs? There are three components of manufacturing cost. One is direct materials, another is direct labor, another is manufacturing overhead. What is direct labor? Maybe you are thinking that why the operations manager will discuss about the cost of goods manufacture schedule. The operations manager is responsible to minimize the cost of raw materials. The operations manager is responsible to minimize the manufacturing overhead. The accountant is responsible only for recording the cost. Accountant is not responsible to increase or decrease the cost. The accountant is not responsible to explain the cost. The accountant is responsible for recording the cost. Say for an example, if you use raw materials for $146,400, the accountant will record it. Raw material consumed 146,000, and they will divide into debit and credit because there is a recording system. But I'm not talking about the recording system. I'm talking about the manufacturing cost components, because the operations manager are responsible for containing the manufacturing cost, and that will lead to reduction of cost of goods sold. If you can minimize the manufacturing cost, your cost of goods sold will be minimum. So what is direct materials? You can tell me. Can anybody tell me
Sir,
what?
these
The
materials
material
are
which directly used in the product.
Good. So this is a chart. The materials you can trace directly with the chart is known as the direct materials. Fabric is the direct materials. There are materials which is known as indirect materials. Those are also used by the manufacturers, but you cannot trace the indirect materials in your finished output. That is the difference between direct materials and indirect materials. Direct materials, you can trace the direct materials with the finished output, and the materials that is important for manufacturing, but it is not a part of the finished output, is known as the indirect materials. Say for example, in garments companies, garments factories, they use lubricants to run the machines smoothly. So if you can trace lubricants in your finished output, what will happen? The product will be rejected. That's why indirect materials is important to run the machine, but the material is not a part of the finished output. So direct materials the manufacturer are using, and the direct materials, maybe in your accounting course, you know there are three types of inventories. Raw materials inventory, finished goods inventory, and work in process inventory. Work in process, we are talking about the conversion process, converting inputs into outputs. This is how they use the cost and raw materials while they are converting inputs into outputs. Ultimately, the inputs are given there in the work in process, isn't it? Say for an example, you bought raw materials for $100, and you put $100 equivalent raw materials in the production process. Production process means work in process. Work in process, in the beginning of the year, you put 100 equivalent raw materials into the production process, but you have got 90 units of 90 units equivalent output from the process. So 10 raw materials equivalent is still in the process, isn't it? That is known as the work in process. Work in process at the end of the year, 31st December. So you put 100 equivalent raw materials, but you have got 90 units output equivalent to 90 units raw materials. So 10 unit raw material is still in the process. This 10 units of 10 units raw material equivalent work in process at the end of the year will be the beginning work in process in the next year, isn't it? So when you will start manufacturing in the next year, what will happen? You will take as the beginning work in process inventory, beginning work in process inventory. Then you will add more values. You will put raw materials in the work in process. And raw materials have beginning inventory, ending inventory, because you are buying raw materials, but you are not using 100% raw materials. If you can use 100% raw materials, then there will be no beginning inventory, there will be no ending inventory. Purchase equivalent, purchase raw material purchase will be equivalent to raw materials used. And if you have raw materials inventory, then beginning raw material purchases during the year minus raw materials available in the inventory on 31st December. Then you will get the raw materials used. That means how much raw materials you have given in the work in process. This is raw materials used. It is the concern of the operations manager because ultimately manufacturing cost includes these raw materials. Raw materials, if the operations manager through the supply chain can buy the raw materials at lower cost, the manufacturing cost will decline. The operations manager is responsible to find out the low cost source of raw materials. Low cost doesn't mean lower quality. You must buy the qualityful raw materials. So while they are buying the raw materials, the operations manager deal with the supply chain issues. We will discuss supply chain later. For the moment, when the operations manager is responsible for work in process, they are also equally responsible for raw materials, whether using raw material, good raw materials, low price raw materials. And then the operations manager apply labor in the work in process because the labor is directly involved with the production process, work in process labor. And then the operations manager responsible for manufacturing overhead. Manufacturing overhead means indirect materials, indirect labor, and all other expenses in the factory. Say for an example, the depreciation of the sewing machines, water and electricity bills of the factory, factory repairments, insurance payment, factory insurance payment, or usually in our country, we pay some taxes to the government, factory land tax. All the expenses in the factory is referred to as manufacturing overhead other than direct materials and direct labor. So you are adding value. You are adding value in the work in process by putting raw materials. You are adding value to the product by putting labor. You are adding value by putting manufacturing overhead, and it is known as the total manufacturing cost. And from the total manufacturing cost, you will not get 100% output. Some will be remain there in the process, and you will deduct the amount processed. That means that stocking. You will put 100 equivalent inputs, but maybe you will get 90 equivalent outputs. So 10 equivalent outputs may be in the process. You will deduct this, then you will get the cost of manufactured, cost of goods manufactured. Cost of goods manufactured, operations managers are responsible to contain the cost of goods manufactured. And cost of goods manufactured with the cost of goods manufactured, if you adjust the finished goods inventory. Finished goods inventory means beginning inventory of finished goods and ending inventory of finished goods. You will add beginning inventory of finished goods and deduct the ending inventory of finished goods. Then you will get the cost of goods sold. Cost of goods sold means the cost of goods that have been sold out. The cost that you already sold is known as the cost of goods manufactured. The cost of goods cost of goods sold. So you will adjust the finished goods inventory, add beginning finished goods inventory, deduct ending finished goods inventory, then you will get the cost of goods sold. And when you will subtract the cost of goods sold from the sales, you will get the gross profit. So operations manager is responsible to contain the manufacturing cost, and that will lead to increase the gross profit. And how they can contain the cost. Say for example, labor cost. If you can produce the good with the least amount of lead time, your labor cost will save. And how you are utilizing labor, these are reflected here in cost of goods manufactured. So operations manager is responsible to deal with the manufacturing cost. So cost of goods manufactured schedule as shown on the right is an internal financial schedule. So internal financial schedule that shows each of the cost elements. The cost elements are shown here. So this is very important for the operations manager, because today's operations manager are working in the high performance work system. Under the high performance work system, you need to know where is the linkage of your job. Are you doing your job only converting inputs and outputs, or you are thinking about the objective of the company? What is the objective of the company? The objective of the company is wealth maximization, or it may be profit maximization. When you are dealing with the profit maximization or wealth maximization, you have to minimize the cost, best utilization of resources. And if you can utilize the best resources, then what will happen? Your company's profit or wealth will increase. So you as a operations manager is also responsible for the profit generation of the company, wealth generation of the company. You are working in a high performance work system. Operations manager also deal with the average cost of production. Here the output. Here it says that when you are producing more number of units, what is happening? When you are producing more number of units, your average cost is declining. Long range average curve. When you are producing more amount of output, your average cost is declining, and it is known as the economies of scale. Economies of scale means that you will produce more outputs, and the more output means that you will produce at 100% capacity. Beyond 100% capacity, you have to take one more factory, and the average cost will again increase. So the operations manager role will be contain the production at 100% capacity. So operations manager deals with the average cost. And to deal with the average cost, the operations manager subdivide the cost into two categories. There are two categories of cost. One is known as the fixed
Fixed
cost,
cost,
another is known as the
variable
variable
cost.
cost. Did you discuss these issues here in the classroom?
No, sir.
No. Okay. So the sum of the fixed cost and variable cost is known as total cost. Sum of the fixed cost and variable cost is known as total cost. No, variable cost. What is variable cost? Variable cost means the cost that is varies with the level of output. When you are producing 1 unit, Say for example, fabric for the garments manufacturer is variable cost. When you are producing 1 unit fabric, you have to use, say for example, $10 equivalent fabric. When you are producing 2 units, you have to use $20 equivalent fabric. When you are producing 3 units, you have to use $3 equivalent fabric. So as the quantity increases, your variable cost will increase in total, or total variable cost will increase. But what about the unit variable cost? Unit variable cost is same, $10. $10 for first unit, $10 for second unit, $10 for third unit. So the nature of variable cost is that the total variable cost increases. Total variable cost increases, and average variable cost is fixed. That means $10 for each unit. Our unit variable cost is fixed. And fixed cost. What is fixed cost? Fixed cost means that the cost that is fixed for a factory. The cost that is fixed for a factory, whether you are producing any product or not, whether you are producing 2 units or 200 units, it doesn't matter. The fixed cost will remain same. Fixed cost will remain same. Say for an example, the rental of the garments factory is same whether you are producing 1 unit or 2 units. Say for an example, the rental for a garments factory is $100. $100. So when you are producing 1 unit, you have to pay $100. When you are producing 100 units, you have to pay $100. And we must think that what is the maximum capacity of the factory? Say for an example, the maximum capacity of the factory is 100 units. 100 units. The factory can produce 100 units. And if the factory wants to produce more than 100 units, then the factory needs to rent out 1 more factory. The same principles applies in your classroom. What is your classroom size? Your classroom size is 50, 45, is it? So if the university recruits 50 students, they cannot give any room for the more 5 students in the existing classroom. For the more 5 students, the university needs to allocate a new room for them. So the university's cost will increase. The university needs 1 more teacher. So your fixed cost is increasing, rental is increasing, the teacher's salary is increasing. These are the fixed costs. So for a class, the maximum number of unit is 45, and this is the maximum capacity. For a factory, say for an example, in our example factory, the total or the maximum output the factory can produce is 100 units. 100 units, and what is the fixed cost? $100. If the factory produces 10 units, what will be the unit fixed cost? $100 divided by 10, $10, isn't it? Are you getting the point? That's why classroom is very important. It's very difficult to use board, and we are not ready, is it? So are you getting the point?
Yes, sir.
Total fixed cost is $100, and the $100 will be remain same whether you are producing 50 units or whether you are producing 100 units. If you produce 50 units, what will be the per unit fixed cost? $100 divided by 50 equals
Sir, $2.
$2, isn't it?
Yes, sir.
Yes.
If you produce 100 unit and the fixed cost is $100, what will be the unit fixed cost?
$1.
$1. So are you getting the point? When you are increasing the output, your fixed cost is declining. Is it? Per unit fixed cost is declining. So when you are producing 50 units, your fixed cost is $2. When you are producing 100 units, your fixed cost is $1. $1, is it? So now sum of the fixed cost and variable cost for, say for example, Q means 50 units. Your variable cost is $10 per unit, variable cost is $10 and fixed cost is $100. So now you are going to produce 50 units Q. When you are producing 50 units, what will be the average cost? Average cost means variable cost and fixed cost. What will be the average cost? Your variable cost is $10 per unit, isn't it?
Yes, sir.
And fixed cost for 50 units is $2. Total is $12. Is it? Average cost is $12. Per unit cost is $12. C. So when you are producing 50 units, your average cost is $12. $10 for variable cost and $2 for fixed cost. Fixed cost $12. C is $12. Now you are thinking to produce at 100% capacity. Your production factory's capacity is 100 units. That means you can produce maximum 100 units. You can produce maximum 100 units. When you are producing 100 units, your average or unit variable cost will be same as $10 because you need $10 equivalent raw materials for each unit. All right.
Yes, sir.
And how much will be the fixed cost for per unit?
It will be $1. It will
$1.
decline.
So what will be the average cost?
Sir, $11.
$11. So your cost will come down to from $12 to $11 when you are producing 100 units and your factory's capacity is 100 units. You cannot produce more than 100 units. And when the output of a factory is at 100% equivalent, or when the factory can utilize the 100% capacity, the cost will be minimum because the fixed cost will be spread over the 100% capacity. Fixed cost will spread over the 100% capacity. So your cost will be come down from C to C1 or $12 to $11, and you will be in utopia or you will be in the era of minimum cost. So what is the role of the operations manager to know about the cost behavior? The essence is that the factory manager, production manager will analyze the variable cost and fixed cost, and the production manager, operation manager is responsible to utilize the factory at 100% capacity. That means the operations manager will accept production order at 100% capacity. Because beyond 100% capacity, say for an example, if you are interested to produce quantity 150, what will happen? You have to take one more factory. That means your $100 additional $100 you have to invest for a new factory. Your factory overhead or your fixed cost will be $200, and again your average cost will increase. Average cost will increase. So the operations manager will try to produce at 100% capacity. Operations manager will make sure that they are producing product at 100% capacity. That will bring down the cost at minimum level. Minimum level. The process is known as economies of scale. Economies of scale. And the economies of scale are the cost advantages companies experience when production becomes efficient, as fixed cost can be spread over a larger amount of goods. Are you clear what is economies of scale and why economies of scale is very important for the operations manager? Because the
Yes, sir.
operations manager will produce at 100% capacity. The example is given here. The example is also your homework, and no matter, we can learn here, but you have to submit the homework, and the homework you will submit in Excel sheet. That means you will develop this curve. You will develop this curve. All right, in Excel, and then you will submit the Excel file. Here, draw a long range average curve. The operations manager will draw a long range average curve. The variable cost of a production factory is $10 and the fixed cost is $100. The production capacity, that means maximum capacity is 5,000 units. Calculate the average cost and draw a cost curve showing the 1,000 units production, 2,500 units production, and 5,000 units production, and 6,000 units production. Assume that producing beyond 100% capacity requires a more production facility. That means the factory capacity is 5,000 units. So when you are going to produce 6,000 units, what will happen? You have to rent one more factory. That means the fixed cost will increase by more $100, $100,000. So let's calculate the average cost. Here the units produced is 1,000. Units produced 1,000, 2,500, 5,000, and 6,000. These are the information given there in the problem, and the per unit variable cost is $10, $10, and $10. When you're producing 1,000 units, the per unit variable cost is 10, 10, 10, and 10. And the variable cost, total variable cost, this means total variable cost 10,000, 25,000, 50,000, and 60,000. That means multiplying by the quantity. And fixed cost is 100,000, and per unit fixed cost 100. 100,000 is divided by 1,000. 100,000 is divided by, you're producing 2,500 units divided by 2,500 units. Your fixed cost per unit fixed cost is 40. When you are producing 5,000, your per unit variable fixed cost is $20. And when you are going beyond, your 100% capacity, that means 6,000 units, then your additional 100,000 will be added with the fixed cost. In fact, you need to have a new factory, new facility. Your fixed cost will increase from 100,000 to 2,000, and then the per unit fixed cost will increase to 33. So when is the when it will be the minimum per unit fixed cost?
At the maximum capacity, when
When the
5,000.
company can produce at 100% capacity. And average cost means fixed cost plus variable cost. 100 plus 10 per unit cost. Average cost or per unit cost? 110, 50, 10 plus 20, 30, 10 plus 33 equals 43. And then you will draw this picture using, draw this figure using your Excel. Just line. Is it? Here is the units cost, and here is the units produced. When you are producing 1,000, your average cost is $110. When you are producing 2,500, your average cost is 50. When you are producing at 100% capacity, your average cost is 30. And when you are going beyond your capacity, producing 6,000 unit, and your per unit cost will be 43. So what will be your job as an operation manager? You will produce at 100% capacity. That will minimize your cost. So rather than receiving an order for 2,500 units at 50, you can take 5,000 units order at $30. That will minimize your cost, and you will be in maximum profit level. Minimum cost means you will be in maximum profit level. So operations manager, why variable cost analysis is important for the cost behavior analysis is important for the operations manager? Because the operations manager can decrease the average cost. So you will use this information, and you will draw this curve in Excel and then submit as the assignment. All right.
Sir, do we have to submit online or hard copy?
Online submission. The links already generated, maybe. Have you got the notification of the links for the assignment?
Yes, sir.
No. So the operations manager is also very much responsible for quality. Quality is a very important issue for the operations manager. Quality. What is quality? Quality means it is the conformance to the standards. Quality means conformance to the standards. There will have some standards, and if you can meet the standards, that is known as the quality. And international standardization organization, or ISO, they set the standards, and 9,000 standards is known as the quality system. To make sure that you are producing a quality product, then you have to have the ISO 9000 certification. ISO 9000 certification standards have become international measures of quality. To become ISO 9000 certified, a company must demonstrate a quality control system is in use. So you have to have the quality control system. We will discuss quality control system in a different chapter, how to control the quality and statistical quality control. And the system clearly defines an expected level of quality. What will be the average or expected level of quality that must be reflected in the quality control system. This system is fully operational and is backed up with detailed documentation of quality control procedures. The intended level of quality is being achieved on a sustained basis. That means only one product is producing with 100% compliance of the standards, and other products are not producing. It is not the indicators of being quality full product or producing quality full product. So ISO 9000 standards, these are certified certification system. You will develop the system in your production factory. And after developing the total quality control system, you will invite the International Standardization Organization for inspection. After proper inspection of your quality control system, they will certify. And after receiving the certification, you can say that you are quality certified company. That means you have ISO 9000 certification. And the certification, one-time certification is not enough. The ISO will revise or review or inspect your facility whether you are maintaining quality properly or not. Upon regular interval or surprise inspection will also be done by the company, organization, international standardization organization. So quality for the moment means conformance to the standards. And if you are interested to be a certified quality control, certified quality maintenance organization, then you have to apply for ISO 9000 to the ISO International Standardization Organization. They will inspect your facility. They will inspect your quality control system, documentation. After inspecting, they will give a certificate. That is known as the ISO 9000 certificate. We will also discuss more details about quality in quality TQM chapter, or total quality management and quality. So it is the job of the operations manager to control the quality. If you fail to control the quality, what will happen? You will lose the market, and you cannot compromise quality with cost. You are thinking that you will buy low cost raw materials to produce low cost product, but there is no option to trade off between quality and cost. You must produce the best quality product with low cost. That is the principle or philosophy of operations management. Operations managers also deal with flexibility, when they're producing goods, converting inputs into outputs, they also take care of the flexibility issue. Flexibility in coping with incoming materials of varying quality level. Flexibility in satisfying the market demand for the products varying quality levels. Flexibility in competing against new products introduced by the competitors. Flexibility in modifying existing products. Flexibility in changing delivery and development schedules. Flexibility in accepting demand volumes of varying levels. Flexibility in making changes to the product mix. Flexibility in coping with changes to the resource mix. So the word flexibility is related to many different issues. Do you have the capacity to compete with the competitors? The competitors is offering better product than you. What you will do? Do you have the flexibility to produce more product mix? Do you have the option to use different materials to produce the product? Say for example, in today's world, we are using this is not the cotton dress. This is synthetic dress or resource mixed dress. Cotton is there, and also synthetic is the synthetic means petrochemicals and the raw materials for synthetic. So do you have the options to accept resource mix? Do you have the option to use product mix? That means you are producing only shirt. Do you have the option to produce jacket? Do you have the option to produce trousers? So if the competitors are coming, then you have to have the flexibility in operations. And flexibility especially is mainly related with the adoption of technology. If you are techno-savvy company, then the flexibility is more. That means the applications of AI, artificial intelligence, and operating in 4IR, fourth industrial revolutions, ultimately encourages flexibility to compete with each other. So you have to have the flexibility in your operations. This is all for today. So if we sum up the total lecture, then what we can say that the operations management means converting inputs into outputs. While they are converting inputs into outputs, the output must be qualityful, and the quality must be maintained at the conversion process, at the process stage. The operations manager must take care of the time. Take care of time means that the operations manager will try to minimize the conversion time. When the operations manager will try to minimize the conversion time, this means that they are minimizing the cost of manufacturing. They are minimizing the direct labor cost. They are minimizing the manufacturing overhead cost, they are minimizing the, material cost. And material cost, whether you can buy raw materials at low cost, you have to discuss about the supply chain. Who are the suppliers? Is the product available in our country, or we have to import the product? Is the imported product is better than local product? Can we produce the product in-house, or we have to outsource the product? So you have to think about the supply chain when we are coming to raw materials cost. Then your capacity utilization, the cost issue the operations manager must address. And when they're addressing the direct material cost, direct labor cost, and manufacturing overhead cost, the operations manager is also responsible to analyze the cost behavior, because cost behavior analysis helps identify whether you are the minimum cost manufacturer, or still you have the option to minimize the cost. That means you will spread the fixed cost over the 100% capacity. You will produce at 100% capacity. So the operations manager will minimize manufacturing cost. The operations manager will produce at 100% level. That will ultimately bring the result. That means the minimum manufacturing cost. And the operations manager must think of adoption of technology, and technology or techno-savvy company can bring flexibility in operations, flexibility in resource mix, flexibility in, that means the inputs you're using. Can you use the different input? Can you use the input or resource mix in your input to produce the output? So this type of flexibility for competition is important, and you cannot compromise quality, cost, and quality. There is no trade-off between cost and quality. You have to maintain the standard quality with minimum cost. And when you are transforming inputs into outputs, operations manager are adding value. That means increasing value at each stage. That means using labor, using land, using capital, and also the entrepreneur profits are added with the value added. And the value added is also known as the GDP of a country, with some justifications or adjustments. And when the operations manager are converting inputs into outputs, they are taking care of efficiency. And efficiency means increasing productivity over time and comparing productivity with the other competitors to know the efficiency. And efficiency means that the productivity is at high level and you are utilizing your resources for least possible cost. You are utilizing your resources most. That is efficiency. That means increasing productivity means output divided by input. When you can minimize the input, your efficiency level will increase. So any other issues not clear to you, we can discuss. The floor is for you at this moment. Hello, gentlemen. Are with me?
Yes, sir.
Yes, sir.
Do you have any questions?
No, sir.
So what is operations management is partially clear to you. Maybe next class we'll begin with strategic operations management or operations strategy chapter 2. If everything is okay. All right.
Okay, sir.
Yes, sir.
Okay. Thank you for your patience hearing, and I will upload the recording there in the Canvas system.